Welcome back to the deep dive. Today we are strapping into the engine room of the global automotive world. It's this massive industry that is not only, recession resistant, but is utterly essential.
And yet it's almost completely invisible to the average person, to the average driver.
Exactly. We're moving far past the shiny retail stores that you see on every corner, like AutoZone or O'Reilly. We're diving straight into the critical, kind of grimy infrastructure that underlies every single serious collision repair and really every independent mechanical service done globally.
And we are focusing on one company in particular, LKQ Corporation, ticker symbol LKQ. When you look at the auto sector, you have these, high growth, high multiple retailers, and then you have this company.
Right.
LKQ is the premier global provider of what they call alternative parts. They essentially act as a critical deflationary element in the entire insurance and repair ecosystem.
Well, he's always valued at a discount.
A deep, deep discount compared to its retail peers and even a lot of industrial peers.
And that is the core contradiction, really, the puzzle we're setting out to resolve today. Our research makes it pretty clear. The market often struggles to understand LKQ because it just gets mentally lumped in with those high-flying automotive retailers.
Right. But if you peel back the layers, if you really look at it, the business model is fundamentally a complex, capital-intensive, it's an industrial logistics and manufacturing operation.
And not a store.
It is not a store. And that confusion, that identity crisis really in the public market is what creates this persistent valuation discount.
So if you're an investor expecting, I don't know, a simple, scalable, capital-light retail playbook, you're looking in the wrong place.
You won't find it here. LKQ operates right at the nexus of the global aftermarket, the circular economy. And we're not kidding. We are talking about recycling millions of tons of steel and precious metals, and on top of all that, the highly regulated insurance claims system.
So if I'm an insurance company, let's say, or even a big fleet operator, LKQ isn't just a parts provider. They are a cost containment solution.
That's the perfect way to put it.
If my repair costs, or severity as they call it, are skyrocketing, which they are, because cars are getting so complex, LKQ is my countermeasure.
Exactly. Their entire reason for being is to provide viable, high-quality alternatives that are significantly cheaper than the expensive original equipment manufacturer or OEM parts.
Okay. So to understand the investment case here, what are the pillars?
You really have to understand its three foundational pillars. First, its dominant fortress-like, moat-protected position in North American salvage and recycling. That is the core.
Okay.
Second, its sprawling, complex, but absolutely massive European distribution footprint. And third, its exceptional ability to convert its profits into robust free cash flow. That's what's shifted the company from, a growth by acquisition story to a more disciplined capital return story.
So let's start there. Let's unpack that operational difference.
Let's do it.
Okay, let's unpack this core business model and this crucial concept of alternative parts utilization, or APU. What exactly does that even mean, APU, and why is LKQ the only real one-stop shop for a professional repairer?
APU just refers to the use of any part that is functionally equivalent but significantly cheaper than the new component you'd get directly from the vehicle manufacturer, the OEM.
Okay, so anything that's not from Ford or Toyota directly.
Pretty much. And in the collision world, where insurance carriers are footing, 80% or more of the bills, APU is not optional, it is mandated.
Right, the insurance company is demanding it.
They're demanding it, and LKQ's huge advantage is that they are the only national vendor that offers the full spectrum of these alternatives, whether it's used, new aftermarket, or rebuilt, from a single point of order and a single delivery.
And that simplifies things for the repair shop.
Drastically. It cuts down on administrative time, which matters hugely for their profitability. You make one call, you get one invoice, one delivery truck.
Okay, so let's start with the heritage of the company. Recycled or salvage parts. This is where that industrial complexity really begins. How does LKQ turn a totaled car into a high-margin product?
This is the differentiated industrial core of the North American business. It all starts with acquiring total loss vehicles, cars that cost more to repair than they're actually worth.
Right, the insurance company just writes it off.
They write it off. And LKQ acquires these vehicles primarily through these high-volume salvage auctions run by companies like Copart and IAA. These are vehicles where the title has been surrendered to the insurance company.
And once LKQ buys that wreck, What's the internal process? I mean, it's not just sitting in a field, right?
No, absolutely not. It moves to one of their dismantling facilities. And you should think of this as a factory process, not a simple junkyard.
An assembly line in reverse.
That's a great way to think about it. The vehicles are systematically harvested for their highest value components. Engines, transmissions, doors, headlamps, all the internal electronics.
And then what happens to those parts?
They're cleaned, inspected, coded, and cataloged into a massive inventory system. And crucially, because they were manufactured by the OEM, they guarantee a perfect fit and perfect quality.
But at a huge discount.
A massive discount, 30 to 70% off the price of that same part if you bought it new from the dealer.
So they're selling a used OEM product. This seems straightforward on the surface, but you mentioned inventory risk management using these sophisticated algorithms. How do they know what a total car, a VIN number, is actually worth to them?
Well, it's highly technical, and this is a key part of their moat. They absolutely cannot afford to overpay at auction.
Sure.
They have these proprietary algorithms that analyze the vehicle identification number, the VIN, and they cross-reference it with decades of historical data on accident damage, model year, regional demand patterns for specific parts.
Wow.
So this predictive model forecasts the likely high-value component yield from that specific vehicle before they even place a bid.
So they know, okay, this 2022 Ford F-150 with front-end damage is probably going to give us a good transmission and 2 good doors, and that's worth X dollars to us.
Exactly. This predictive capability lets them manage their acquisition costs and their inventory risk incredibly well. It turns what looks like a messy salvage operation into a sophisticated, predictable industrial procurement process.
That's a huge differentiator. Okay, so that's pillar 1, the recycled parts. Now pillar 2, aftermarket or new parts. These are the parts that are manufactured specifically to compete with the OEM, often from overseas.
That's right. These are generic parts, typically manufactured in high volumes by third parties, predominantly in Asia. Taiwan is a major sourcing hub for this stuff.
So these aren't Ford parts, they're just parts that fit a Ford.
They replicate the form, fit, and function of the OEM parts. Brands you might have heard of, like TYC for lighting or Depot, they are staples here. LKQ's role in this is massive logistics importing, quality controlling, and distributing millions of these parts.
And these are critical for the collision side of the business, right? Especially for, like, non-structural cosmetic things.
Precisely. If you need a new bumper cover or a side mirror for your 5-year-old car, the cost difference between the OEM part and the certified aftermarket part is often so substantial that the insurance company will make the aftermarket option the default choice.
And the third category, remanufactured parts. You call this the most technical. For anyone listening, what is the key difference between a used part and a remanufactured part?
The difference is immense, and it's why remanufacturing is a complex industrial business in its own right. A used part is just pulled off a car and resold. It's inspected, but that's it.
As is.
As is. A remanufactured part, typically a major mechanical assembly like an engine or a transmission, undergoes a full industrial overhaul.
So they take it apart.
Completely. The process involves totally disassembling the core, cleaning every component, precisely machining the internal surfaces to meet or even exceed original factory specifications. We're talking micrometers of tolerance here. And then reassembling it with all new wear components. Bearings, seals, gaskets, pistons, you name it.
So it's essentially taking a failed part and running it through a secondary factory process. And you end up with a product that is often better than the original because maybe they fix common weaknesses.
Exactly right. And it carries warranties that are comparable to a new part. The value proposition is just straightforward. If your transmission dies, the alternative is often paying, I don't know, $15,000 or $20,000 for a new one from the dealership.
Which would total the car.
It would total the car. A high-quality remanufactured unit provides a reliable solution at a fraction of that cost, making it extremely attractive to the owner of an older vehicle. And for LKQ, the margins are strong because the barriers to entry, the capital for the machining equipment, the skilled labor, the quality certification are enormous.
So LKQ has this trifecta of parts. But the real power, the ultimate moat, especially in North America, seems to be their relationship with the insurance industry and the software that actually dictates repair decisions. Tell me about CCC Information Services. How does LKQ use this software to steer volume?
This is maybe the most important operational dynamic to understand. CCC provides the estimating and claims management software used by nearly every major insurer and collision repair shop in North America.
So it's the industry standard.
It is the standard, and LKQ's entire inventory is integrated directly into that system in real time. So when an adjuster or a shop is writing up a repair estimate, the system is designed to automatically flag or even substitute an available LKQ part, whether it's recycled, new aftermarket, or reman if it meets the insurer's criteria and is cheaper than the OEM option.
So wait, the system doesn't just suggest the cheaper part? It effectively mandates its consideration by just dropping it right into the repair plan based on the insurance company's own rules.
Precisely. It's an embedded moat. The insurer mandates a certain level of APU to contain their rising costs, and the software is the enforcement mechanism. And since LKQ is the only vendor with the national scale, the logistics, and the inventory breadth to fulfill those systemic demands reliably,
The volume just naturally flows to them.
the volume is effectively steered away from smaller local yards and directly to LKQ. This non-negotiable relationship is the core reason LKQ's North American business is so incredibly robust.
And for the repair shops themselves, the big ones, why can't they just use their local salvage yard? Why go to LKQ?
It all comes down to speed and scale. The big multi-shop operators, the MSOs like Caliber or Gerber, these are massive operations running thousands of repair bays. Their profit is directly tied to throughput, getting the car in and out quickly.
Right, an empty bay has lost money.
It's lost money, so they need guaranteed quality, they need standardized billing, and critically, they need national just-in-time delivery. LKQ's network can guarantee delivery within 24 to 48 hours to the vast majority of locations in the U.S. A local yard, while maybe it's cheaper on one part, cannot provide that consistent national logistics guarantee. Waiting 3 days for a door means lost revenue for the MSO, so they choose the reliability of LKQ every time.
Now we're seeing why the structure is so important. LKQ is not this monolithic thing. It's a conglomerate of very different operations. Let's start with the powerhouse. Wholesale North America. You call this the moat business.
It is. This segment is the highest margin and the most differentiated part of the company. It's a completely vertically integrated operation. They control everything from the vehicle acquisition at the auction all the way to the final distribution to the body shop.
And the regulatory barriers to entry here are, they're legendary. It's not just about spending money, it's about real estate.
Absolutely. The primary hurdle is regulatory and zoning difficulty, what people often call MBY, not in my backyard zoning issues.
Nobody wants a junkyard next door.
Nobody wants a new, large-scale industrial salvage operation in their jurisdiction. The environmental concerns, noise, traffic, securing the necessary permits and dealing with environmental compliance is immensely difficult and time-consuming. This effectively caps the supply of new salvage capacity in the U.S.
So the result is that LKQ's existing portfolio of permitted real estate, their yards and their dismantling facilities, it becomes a strategic fortress. They have an irreplaceable asset base.
Precisely. To replicate LKQ's national footprint would require billions in capital investment, plus years and years of bureaucratic and legal battles with local governments. This high barrier to entry ensures the North American business enjoys, oligopolistic pricing power and stable, high profitability. Historically, they're getting strong EBITDA margins of 16 to 18%.
Okay, now let's talk about the dual revenue stream, because it's not just about selling fenders and engines, it's also a massive commodities recycler.
That's the second and much more volatile side of the business. Once the high-value parts are harvested from a car, the remaining vehicle hulk is crushed and sold as scrap steel. And, more significantly, LKQ processes the catalytic converters, which contain valuable precious metals: platinum, palladium, and rhodium.
You mentioned a natural hedge against commodity volatility. How does that actually work in practice?
It's a rough correlation, but it's important. Generally, when there's broad inflation in the economy, new car prices go up, which means the residual value of used cars also goes up. So the price LKQ has to pay at auction to get those wrecks goes up.
Okay.
But at the same time, periods of high inflation often correlate with high global demand for industrial inputs and precious metals. So scrap steel and rhodium prices also go up. The increased revenue from the scrap side helps to offset the higher procurement costs on the acquisition side.
That sounds good on paper, but if that hedge isn't perfect, it must introduce significant noise into their quarterly earnings, right?
It introduces major volatility. For instance, we saw a massive sharp correction in rhodium prices in late 2023 and early 2024. That can happen completely outside of the regular economic cycle.
And rhodium is a big deal for them.
A huge deal. When rhodium, a component that contributed significant revenue per vehicle, drops precipitously, that's a direct, unmitigated hit to the gross margin of the salvage operation. And there's no corresponding reduction in their fixed operating costs. So that is the nature of the risk they manage, and it's one of the big reasons the market assigns a discount to this segment.
Let's pivot sharply now and cross the Atlantic to Europe. This is fundamentally different business from what I understand.
Completely different. LKQ Europe is essentially a massive logistics and distribution operation for new aftermarket mechanical parts. It's not primarily a salvage-driven business like North America is.
So not collision parts, but maintenance parts.
Exactly. Think of every routine maintenance part. Oil filters, brake pads, timing belts, alternators, wiper blades. This business is structured much more like, say, Genuine Parts Company's Alliance Automotive Group.
And LKQ built this through a sheer roll-up strategy, just buying dozens of established local champions across the continent. What does that customer base look like?
It's highly fragmented. Europe has a vast number of small, independent workshops or garages that rely on high-frequency, just-in-time delivery. LKQ assembled this scale by acquiring giants all over the continent. Eurocar Parts in the UK, Stahlgruber in Germany, Rhiag in Italy, and many others.
But the challenge there is immense. Each acquisition came with its own IT systems, its own logistics platforms, its own national culture.
And that fragmentation, that lack of integration, is the primary reason why the European margins structurally lag the North American fortress.
How far behind are they?
Historically, European EBITDA margins have hovered around 8 to 10%, which is respectable for distribution, but it's half of what the salvage business does.
So the strategic imperative for management has completely shifted now. It's not about buying more. It's about integrating what they have.
Exactly. It's known as the One LKQ Europe program. And the goal is to weld all these disparate local empires into a single, cohesive, efficient platform to unlock massive procurement and logistical synergies.
Before we dig into that strategy, I want to clarify the European moat. In North America, it's zoning laws. What protects the distributors in Europe?
It's also a regulatory moat, but it's focused on competition. It's the European right to repair legislation.
Oh, right.
And this is critical because it forces the OEMs, the car manufacturers, to provide technical data, diagnostic information, and service tools to the independent aftermarket. Without that access, the OEM would basically monopolize all the complex repairs on their own vehicles.
So the law keeps the independent garage in business.
It ensures that major distributors like LKQ have the necessary digital inputs and components to keep that independent garage sector alive. It effectively prevents the OEMs from foreclosing on the aftermarket.
Okay, finally, let's quickly cover the third segment, specialty. This is focused on RVs, trucks, and off-road markets. Why is this considered the most cyclical part of the business?
Because it's highly consumer discretionary. When people are feeling wealthy and credit is cheap, they buy RVs, they buy boats, they buy expensive accessories like towing hitches and specialized lighting. We saw a massive boom during the pandemic.
And then the bust.
And then, as interest rates rose and consumers faced inflationary pressure, that market immediately contracted. It historically commands strong margins, but its revenue stream is volatile and, frankly, non-core to the primary business of collision and essential mechanical repair.
And as you teased earlier, this volatility is exactly why this segment became a target for divestiture, which is the major story of 2025.
It became a necessary strategic amputation to clean up the overall investment thesis for the market.
Okay, let's look at the broad industry dynamics now. The structural tailwinds supporting LKQ seem really powerful, and the most discussed one is always the aging vehicle fleet. Could you quantify this trend for us?
This is LKQ's most potent, persistent tailwind. The average age of light vehicles in the U.S. has now climbed to over 12.5 years.
Wow, that's a record high, isn't it?
It is, and it translates directly into higher demand for the aftermarket. Older vehicles simply need more parts, more repairs, and crucially, their owners are actively seeking cheaper alternatives than brand new OEM parts.
And this brings us back to what you call the sweet spot. Can you explain again why the age of the vehicle dictates which channel the dealer or the independent aftermarket it falls into?
Sure. So vehicles typically fall into the expensive dealer service channel for, warranty work from years 0 to 5.
When it's still new.
Right. But once they hit 6 years old or more, they begin to exit that warranty coverage, and the owner is just no longer willing to pay dealer labor rates or the premium OEM part prices. The demographic of cars aged 6 to 12 plus years old is where the independent aftermarket thrives.
And that slice of the pie is getting bigger every year.
It's expanding. Every year, more cars transition into LKQ's core addressable market. This drives structural volume growth, regardless of what the overall economy is doing.
But the flip side of that, the flip side of modernity, is complexity. The sheer sophistication of modern vehicles, all the 8A systems, the high-strength steel, the sensitive sensors, that's causing repair costs or severity to just skyrocket. Doesn't that complexity pose a challenge to the independent shop?
It's a massive challenge, for sure. But ironically, it's a tailwind for LKQ's value proposition.
How so?
Think of a minor rear-end collision on a modern pickup truck. You're not just replacing a steel bumper anymore. You're replacing an integrated bumper assembly that contains multiple LiDAR and radar sensors, specialized wiring, high-strength boron steel structures. The cost of those OEM components plus the mandated recalibration of the sensors forces the average cost to repair into the stratosphere.
So if the cost for the OEM parts is rising exponentially, what does the insurer do? They can't just endlessly raise premiums on everybody.
They are forced, out of pure financial necessity, to push alternative parts utilization harder than ever before. This is where LKQ benefits from what you could call complexity inflation.
The gap gets wider.
The price spread widens. As the price of the OEM part rises, the absolute dollar savings that LKQ provides becomes exponentially more valuable to the paying entity, the insurer. The increased complexity drives up the price of the new part, which increases the necessity of the alternative part.
Now let's tackle the biggest structural headwind, electrification. The transition to battery electric vehicles, or BEVs, is often described as an existential threat. Where does the real risk lie for a company like LKQ?
The existential threat is concentrated almost entirely on the European mechanical distribution business. This is a critical distinction.
Why there specifically?
Because a BEV eliminates the internal combustion engine, the transmission, the fuel system, the exhaust system. All the associated fluids and hundreds of common wear parts are just gone. No more oil changes, no spark plugs, no timing belts, no water pumps, no complex gearboxes.
So over the next 15 to 20 years, as the European fleet electrifies, that core demand for routine mechanical wear parts will just slowly erode.
It will directly pressure the European segment's entire business model.
But for the North American collision side, the propulsion system is largely irrelevant, correct? A fender is a fender.
It's largely collision neutral. When you total an EV, you still need fenders, doors, glass, bumpers, and structural assemblies. In fact, due to the immense weight and torque of EVs, there's a strong argument that accident frequency and certainly severity may actually increase, which drives more business for collision repairers.
So LKQ is essentially using its existing North American moat, that control over total vehicles, to turn the EV threat into a massive strategic opportunity. You mentioned EV battery lifecycle management. How did this new revenue stream actually work?
When an EV is written off as a total loss, the battery pack is the single most valuable component. It often represents 40% of the vehicle's entire manufacturing cost.
Wow.
So LKQ is investing heavily in specialized infrastructure and diagnostics capability to safely test and process these salvaged batteries.
What are the potential outcomes for those batteries once they have them?
There are three main paths. First, if the battery is intact and functional, it is sold as a high-value replacement part, especially since new EV batteries are supply-constrained and incredibly expensive.
Okay, that makes sense.
Second, and this is increasingly important, if the battery is deemed safe but maybe no longer optimal for vehicle use, the modules are repurposed for second-life applications.
Like what?
Stationary power storage, commercial grid stabilization, home solar storage. This generates a completely new industrial revenue stream for them. And third, if the battery is damaged beyond any repair, LKQ can recycle the modules for the critical raw materials, the lithium, the cobalt, the nickel.
That is a brilliant example of capitalizing on an infrastructure moat. They control the flow of the material, the wrecked cars, and now they are acquiring the technical expertise to maximize the value of that material in a high-tech circular economy.
Exactly. It transforms the EV challenge from an environmental threat to their business model into a new technical revenue stream that plays directly to their core strength, procuring totaled assets and extracting value from them.
Okay, let's finalize the industry landscape by looking at the competition. In North America, you've established it's a near monopoly on national distribution. What exactly are the barriers preventing, say, a local salvage yard from scaling up and competing?
It comes down entirely to capital and consistency. A small local yard can only serve its local market. They lack the inventory depth to guarantee the thousands of specific SKUs that a big MSO needs across dozens of states.
You just don't have the parts.
They don't have the parts and they don't have the logistics. To scale up, they would need massive capital investment in real estate, in logistics fleets, in sophisticated inventory management, and the IT integration necessary to interface with systems like CCC. It's a classic case where scale creates an insurmountable advantage. Competition is based solely on availability and speed, and LKQ's existing scale allows them to win on both every time.
What about the disintermediation threat? Why wouldn't a huge MSO like Caliber Collision just cut out the middleman and source their own aftermarket parts directly from Taiwan?
The deterrence is very, very high. It involves assuming a significant amount of risk and complexity that they are just not equipped to handle. MSOs are focused on repairing cars, not on managing global supply chains.
Right, it's not their core competency.
Not at all. If they import directly, they assume all the risk associated with quality control, customs, warehousing, a vast working capital lockup in inventory, and the liability if a part fails. It's far cheaper and less risky for them to pay LKQ a slight premium to manage all that complexity and ensure a guaranteed high-quality part is delivered within 24 hours.
And they can't make their own used parts.
And critically, they still rely entirely on LKQ for used, recycled OEM parts, which they cannot source anywhere else on a national scale.
Europe, however, is a much more competitive landscape.
Highly contested. LKQ competes directly with Genuine Parts Company, which runs the Alliance Automotive Group, or AG. They go head-to-head, especially in the higher-margin UK and French markets. And then there's also Intercars SA, which is dominant and highly efficient in the faster-growing Central and Eastern European regions.
The research highlighted a really fascinating margin contrast. LKQ's consolidated operating margin is around 9.7%, which is superior to GPC's automotive segment at 7.8%, but it significantly trails the pure retailer O'Reilly Auto at nearly 19.5%.
And that difference right there, that 10-point margin gap with the top retailers, is the market's primary rationale for the valuation discount.
That's that simple.
The market assigns a premium to the retail model because it's capital light, it's scalable, and it has higher profitability. LKQ's distribution and industrial model, while essential and high quality, requires massive amounts of fixed assets and working capital, and that depresses its return on invested capital and its overall margin profile. The market struggles to look past that number.
Okay, let's get into those financials, Fen, and focus on the profitability engine. You mentioned gross margins are consistently around 40%. How does LKQ maintain margins that high, especially in what's partially a distribution business?
It all comes back to the North American salvage economics. Remember the initial acquisition cost of that wrecked vehicle?
Right.
Once that cost is recovered through the sale of the first few high-value components, the engine, maybe a transmission, the subsequent sale of parts like doors, bumpers, or smaller electronic modules generates essentially pure, high-quality gross profit.
The cost of goods sold for those parts is basically zero.
It's effectively zero. This structural advantage in the salvage business is what props up the entire consolidated gross margin profile of the company.
And since they rely so heavily on fixed assets, the yards, the warehouses, the truck fleets, the business has really strong operating leverage.
Extremely strong. If they can push incremental volume through that existing logistics network, the revenue flows through to the bottom line at a very high rate. But as you noted earlier, it's a double-edged sword.
Right.
If there's a mild winter, for example, resulting in fewer accidents and therefore fewer insurance claims, the volume drops, and the high fixed costs, the labor, the property taxes, the utilities, they eat into margins very, very quickly. Volatility here is amplified.
Now let's talk about the crown jewel, as it's often called, free cash flow. Why is LKQ's conversion of EBITDA to FCF so consistently high?
It's primarily due to capital efficiency now that they're in a more mature phase. A key driver is the remarkably low maintenance capital expenditure required.
So what they need to spend, just keep the lights on.
Exactly. While a major retailer like an O'Reilly has to spend huge amounts of capital every year building new stores to grow, LKQ's core infrastructure is largely already in place. They typically only spend about 1 to 1.5% of their revenue on maintenance capex.
That's incredibly low.
It is. And it means a large chunk of their operating profit, their EBITDA, immediately converts into free cash flow, which makes that cash flow metric highly reliable and predictable for investors.
But let's address the elephant in the financial room. Return on invested capital, or ROIC. It seems to be stuck in that 8 to 10% range. That's a significant drag on their valuation compared to peers. Why is it so low, and what is management doing about it?
The low ROIC is a direct legacy of the company's roll-up history. When LKQ acquired dozens of companies over the past decade, like Euro Car Parts or more recently Uniselect, they often paid a significant premium over the book value of those assets.
Which creates goodwill on the balance sheet.
It creates massive amounts of goodwill recorded on the balance sheet. This inflated invested capital figure in the denominator of the equation naturally drags down the ROIC calculation.
So to fix that, management needs to either shrink the invested capital base or dramatically improve their asset turnover.
Correct. And management is intensely focused on this now. They are tying executive compensation directly to ROIC improvement. Their strategies involve reducing working capital, improving inventory velocity in Europe, for example, and actively divesting underperforming capital-heavy assets that were dragging down the average.
And this brings us directly to the shrink to grow strategy, the major story in 2025. This really marks a definitive shift from a deal-making M&A culture to a focused operating culture.
Absolutely. The goal is purification. It's about shedding the cyclical and volatile businesses to create a pure-play repair parts distributor that appeals to long-term industrial investors who are seeking resilient revenue streams.
So, detail the first major divestiture for us, the self-service or pick-your-part segment.
LKQ completed the sale of the self-service, scrap-heavy, pick-your-part segment in October 2025 for about $410 million.
And that was crucial because
It was crucial because this segment was heavily weighted toward volatile scrap steel prices and, frankly, the lowest quality, most cyclical revenue streams they had. By selling it, they significantly reduced the exposure to that earnings noise that commodity volatility creates every quarter.
can we quantify the impact of that sale on their volatility?
Well, the self-service segment previously contributed a large portion of LKQ's total commodity revenue. By divesting it, management estimates they have substantially reduced the overall quarterly earnings variance related to scrap steel and precious metal swings. It just cleans up the story for institutional investors who prioritize predictability over maximum margin.
Okay, and then the second major move, the specialty segment.
This was confirmed on December 4th, 2025. LKQ announced they initiated a formal process to sell the specialty segment, the RV, marine, and truck accessory parts business. This is a deliberate exit from the consumer discretionary market.
So by shedding both specialty and self-service, LKQ's structure simplifies dramatically.
It becomes a focused entity concentrating only on essential, non-discretionary automotive repair parts across North America and Europe. That's it.
This really sounds like management making a massive bet that internal execution is the best source of value creation right now. So let's detail those internal growth initiatives, starting with the biggest operational challenge, One LKQ Europe.
This is a complex, multi-year integration project, and they're not just merging balance sheets. They're trying to merge dozens of legacy IT systems, procurement departments, and logistics networks across diverse cultures and languages. Failure here is the biggest execution risk they face.
But the upside must be immense, particularly in procurement synergy.
The key is centralization. Instead of having, say, the Italian business buying parts from Brembo at one price and the UK business buying them at another, LKQ is now leveraging its continental scale.
Buying is one giant.
By centralizing purchasing across all of Europe, they become one of the single largest purchasers of automotive components globally. This grants them massive negotiating leverage with major Tier 1 suppliers, Bosch, Brembo, ZF, driving down their cost of goods sold and structurally lifting the entire European segment's gross margin.
And the second lever in Europe, the private label push. This is pure margin expansion.
Absolutely essential. Private label brands, like their Starline brand, are sourced and quality controlled by LKQ directly. They cut out the middle-tier distributors and the brand marketers.
And the financial impacts.
It's profound. Private label parts carry gross margins that are typically 1,000 to 2,000 basis points. That's 10 to 20 percentage points higher than selling third-party branded parts.
And what is the target penetration for these high-margin private label parts? They must be pushing it hard.
Oh, they're aggressively targeting 30% penetration of their European sales to be under private label. Every single percentage point increase in private label sales has an outsized, accretive effect on the European operating margin, moving them toward that double-digit target and reducing the perceived risk in the segment.
Finally, back in the North American fortress, how do they continue to take market share when they already dominate so much?
It remains a consolidation game, and it's driven by the insurance carriers. As severity costs continue to rise, the carriers push for higher and higher APU utilization. This demand for guaranteed volume and national logistics forces the smaller independent salvage yards to lose ground.
They just can't keep up.
They can't. And LKQ, as the only entity capable of reliably meeting the MSO's service level agreements, is the natural, organic beneficiary of this ongoing industry consolidation. They grow simply by being the largest, most reliable player in a market that demands scale.
So we have this dominant, high-quality, vertically integrated industrial business executing a massive self-help restructuring, focusing on its highest quality revenue, and yet we return to the core issue, the valuation anomaly. Can you just quantify the current dislocation for us?
The dislocation is extreme. LKQ currently trades at, say, 11 to 14 times forward price to earnings.
Which is low.
Very low. Contrast that with the pure-play, high-growth automotive retailers, which command 20 to 25 times multiples. Even if we look at enterprise value to EBITDA, LKQ is often valued at 8 to 10 times, while high-quality industrial distributors like a Fastenal or a Grainger trade north of 15 times. The market is clearly applying a severe discount.
Why such a putative valuation for a clear market leader?
There are really three primary reasons for what the market perceives as a conglomerate discount. First is just complexity. Even after the divestitures, the market is unsure how to value a business that mixes high-margin salvage with lower-margin, high-volume European distribution.
Second is the Europe discount.
Exactly. The European segment carries structural risk, lower growth, higher competition, and that long-term EV threat that the market penalizes very heavily. And third is the commodity exposure. Despite the self-service sale, the remaining exposure to precious metals and catalytic converters still introduces quarterly earnings volatility, and that scares away low volatility funds.
But if we look at the intrinsic value, particularly their cash flow generation, the stock appears to have a very high floor.
That is the core of the value thesis. With that exceptional conversion of EBITDA to free cash flow, LKQ often yields a free cash flow yield of 7 to 8% based on current valuation.
What does that mean in simple terms?
It means that even if the company achieves zero organic growth, a true worst-case scenario, the business generates enough cash to retire debt, pay the dividend, and buy back shares, providing a baseline annualized return of 7 to 8% through capital allocation alone. That high FCF yield creates a strong valuation floor under the stock.
And the sum of the parts analysis often reveals just how disconnected the valuation is.
Absolutely. Many analysts estimate that the North American wholesale salvage business alone, given its irreplaceable moat, its high margins, its predictability, it could command a market capitalization that is close to the entire current market cap of LKQ Corporation.
So you're getting the rest for free.
This mathematically implies that the market is assigning extremely low or even zero value to the massive European distribution footprint and the remaining specialty assets. This asymmetry is the opportunity for patient investors.
This transition from a growth by M&A stock to a capital return story signals a real maturation. How aggressively are they utilizing that FCF engine to reward shareholders?
Very aggressively. The initiation of a quarterly dividend, it's currently 30 cents per share, $1.20 annualized. That translates to a substantial yield of approximately 4% at recent prices. That was a clear signal to the market, and it opened the stock up to income-focused institutional funds.
And they're buying back stock.
They're committed to share repurchases. They retire $360 million in stock in 2024 alone, with a significant $1.6 billion authorization still remaining. This uses that abundant free cash flow to immediately increase earnings per share through, financial engineering.
But they do all this while maintaining strict balance sheet discipline, prioritizing that investment-grade credit rating.
That is non-negotiable for this management team. They actively manage their debt levels, targeting a healthy net debt-to-EBITDA ratio between 2.0 and 2.5 times. They demonstrated this discipline following their last major acquisition, Uniselect, by pausing share buybacks to prioritize debt reduction. It ensures they maintain flexibility and dry powder, reinforcing their position as a high-quality investment-grade industrial.
Okay, let's talk risks, because there are significant external factors that could derail the success of this strategic pivot.
The primary external volatility is still commodity risk, which we've discussed, but the internal execution risk is massive. The One LKQ Europe plan is inherently complex. Successfully merging IT, logistics, and culture across multiple sovereign borders is an enormous undertaking.
And if they fail?
If management fails to execute this integration, the targeted procurement and private label margin expansions will not materialize. That would severely damage management's credibility and lock the European segment into its current lower profitability profile.
And finally, a significant geopolitical risk has emerged recently, particularly relating to the sourcing of those new aftermarket parts.
Yes, the threat of protectionism. Specifically, the potential for Trump 2.0 tariffs. If a new administration were to impose, say, 20 to 25% tariffs on goods imported from China or Taiwan, that would directly hit LKQ's cost of goods sold for their new aftermarket parts segment.
And a large portion of those parts come from Taiwan.
They do. So LKQ would be faced with a difficult choice: absorb the tariff and suffer a severe margin squeeze, or pass the cost onto insurers, which risks harming the demand for APU parts in the first place. This tariff risk is a major uncontrollable headwind that emerged in the latter half of 2025.
This has been an incredibly detailed look at a highly complex but essential industrial entity. We've established that LKQ is not a retail stock. It's a value compounder with an irreplaceable infrastructure asset in North America, executing a major self-help margin expansion strategy in Europe and aggressively returning cash to shareholders who are willing to look past the complexity and the commodity noise.
And if we just pull back for a final thought, the most provocative long-term idea connects back to the very vehicle complexity that LKQ benefits from today. We know modern vehicles loaded with ADAS sensors, specialized wiring, high-strength aluminum cause skyrocketing repair costs, which forces APU usage. But repairing them is only half the battle.
Eventually, these vehicles must be dismantled.
Exactly. And the technical challenge of safely and profitably destroying an EV or an ADAS-heavy truck, which requires specialized real estate, high-voltage expertise, diagnostics, and material handling, that challenge is compounding rapidly.
So the regulatory moat, the difficulty in getting a new salvage yard permitted, will combine with a new technical moat.
That's it. The inability to open new salvage yards means LKQ controls the physical space necessary for this high-tech disassembly. The next level of their moat won't just be logistics, speed, or scale. It will be the specialized technical expertise and the permitted real estate required to manage the incredibly complex circular economy of future mobility. It's about turning that EV threat into a source of enduring competitive advantage that is even harder for new entrants to ever replicate. And that suggests the valuation discount may finally close as the company proves it can execute on this industrial evolution.